Today was a bad day for the stock market, but in just about every single metric right now, you guys, in just about every single metric, the market is massively overvalued. I mean, literally, it's the everything bubble. And, whether it be the Buffett indicator, where the stock market grows faster than the economy, basically what we're seeing right now. Currently, the Buffett indicator is at 206, which is 142% above its long-term average of 85, going back to 1971. You can talk about the price to sales ratio on the S&P 500. It's basically saying that it's the most overvalued market relative to its total sales maybe ever. I mean, it goes way, way back. And when you talk about the insider selling, it's 6 to 1 right now. You have 6 insider sales for every one insider purchase. And that's not a good thing. Jeff Bezos has already sold, just in this year alone, 12.5 billion worth of Amazon. Just last week, he did 1.25 billion. Zuckerberg is up to 2.4 billion. Last week, 153 million more of Meta stock. And the insiders with Nvidia have sold almost 2 billion year to date. And so as corporate execs are cashing out, individual investors have never been more bullish. In fact, recent poll says 46% of investors see a 10% less chance of a market crash. And this is the highest percentage since 2006. So yeah, I mean, it's ominous for sure to see the insiders bailing and the market at all-time high valuations, the euphoria surrounding the Trump risk-on trade. And at the same time, the insiders are quietly tiptoeing out the exits in the middle of this party with all the streamers and confetti going up in the air. They're doing the Irish goodbye. And so I think that's something people should be paying close attention to as we get close to the end of the year here. I think in the end, guys, metals are going to go a whole hell of a lot higher. This was something I think that we should have expected. This is a market where we had massive short positions in London and in the US by the commercial banks that were hugely underwater. And I think they used this optimism as an opportunity to right their balance sheet and to push silver below $30. It was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long. This is an environment where, to me, this is as big of an opportunity as I think you'll ever find in precious metals because nothing has changed whatsoever. Nothing has changed. And the commercial banks and the bullion banks and the central banks are doubling down what they're buying. They're doubling down their efforts and they are using the stupidity of the Western suppression of the paper markets to do just that. So I would say that this should have been expected, maybe not as severe as we thought. But I do think that for the most part, if I had to bet, the worst of the drop is behind us now that we've broken below these numbers. Those short positions will have been covered, and I think you'll see the market turn up from here.
The stock market today reminds me of a party that's well past its prime. The confetti is still in the air, the DJ's playing, but the insiders, the hosts of this celebration, are quietly sneaking out the back door. While everyone else is still on the dance floor, Jeff Bezos, Mark Zuckerberg, and other executives are quietly selling billions in stock. You don't have to be a financial genius to see the disconnect. The Buffett indicator, a ratio comparing the stock market's total valuation to GDP, is sitting at a staggering 206%. For perspective, its long-term average is 85%. Meanwhile, the price-to-sales ratio on the S&P 500 has hit nosebleed levels, signaling the market is wildly overvalued. Insider sales outnumber purchases 6 to 1, and yet retail investors are more bullish than ever. A recent poll showed nearly half of investors believe there's less than a 10% chance of a market crash, the highest level of optimism since 2006. And we all remember what happened in 2008. This dissonance between perception and reality isn't just troubling, it's dangerous. While Wall Street's bulls are charging headlong into a frothy market, something very different is happening in the world of gold and silver. Beneath the radar, central banks and institutional players are methodically accumulating precious metals. Why? Because they understand the fundamentals have never been more bullish for gold and silver. Let's talk about the massive short positions in precious metals. For years, commercial banks and bullion banks have suppressed gold and silver prices through naked short selling metals they don't actually own. This has kept prices artificially low and allowed these institutions to manipulate the market. But here's the catch. These short positions are untenable in the long run. Recent actions suggest these players are quietly covering their shorts. The sharp drop in gold and silver prices wasn't a sign of weakness. It was a calculated move to shake out weak hands and allow these institutions to reset their balance sheets. Now that many of these short positions are covered, the stage is set for a powerful rally. If gold is the safe haven, silver is the rocket ship. Its dual role as an industrial and monetary metal makes it uniquely positioned to benefit from multiple economic trends. The green energy revolution is a game changer for silver. Solar panels, electric vehicles, and 5G technology all rely on silver's unparalleled conductivity. According to the Silver Institute, demand for silver and solar energy alone is expected to skyrocket in the coming years. Combine that with its use in medical devices, water purification, and electronics, and you have a metal that's essential for modern life. Silver isn't just an industrial metal, it's also one of the oldest forms of money. As fiat currencies lose purchasing power due to inflation, silver becomes an increasingly attractive store of value. This is especially true in emerging markets, where silver's lower price point makes it accessible to a broader audience. Here's where things get really interesting. Over the past few years, we've witnessed a tectonic shift in the physical metals market. Countries like China and India, along with other Eastern nations, have been quietly but steadily accumulating gold and silver. They're not doing this haphazardly, they're playing a long game. Historically, less than 1% of futures contracts on exchanges like COMEX resulted in physical delivery. Today, that number is rising. Eastern nations and institutional players are standing for delivery, forcing these exchanges to cough up actual metal. This methodical draining of physical inventories is a calculated strategy to undermine the Western financial system. The London Bullion Market Association, LBMA, and COMEX are seeing their stockpiles dwindle. Silver inventories at the LBMA have been declining at a 45-degree angle, while COMEX is facing similar challenges. The East is effectively using the West's paper-based suppression of precious metals prices to accumulate physical gold and silver at bargain prices. For retail investors, this is a once-in-a-lifetime opportunity. The disconnect between the paper and physical markets has created a unique window to accumulate gold and silver at suppressed prices, but that window is closing. If you've been waiting for a sign, consider this your wake-up call. The fundamentals for gold and silver have never been stronger. Inflation is eroding the purchasing power of fiat currencies. Central banks are quietly hoarding metals, and the East is methodically dismantling the West's paper-based financial system. The question isn't whether gold and silver will go higher, it's how high they'll go.
In silver than it is in gold. And if you look at the stockpiles of the metals that are being held at the LBMA, at the COMEX, and even at the Shanghai Metals Exchange, they are drawing straight down. And what's different now over the last few years, and I would say it started really in 2020, than any time that people have been following this market. And look, I go back to 1990 following this market. That's when I started in this industry. For my entire career, no one stood for delivery. Never. I mean, less than 1% of the contracts did. But this is what's different now. And these countries are smart enough to be methodical about it. So they're standing for delivery. They're draining the LBMA. They're draining the COMEX very slowly, very methodically. If you do it too fast, you get a force majeure, you get some sort of a default and the whole thing blows up. You cut off your nose to spite your face. Instead, they play the game with the West. And the game that the West has played is to support the illusion of the strength of the bond market, the strength of the currency. And they never counted on these countries being coordinated, sophisticated, motivated, and wealthy enough to stand for delivery, but also smart enough to do it in a methodical fashion, to not raise the red flag fast enough. But I think in the silver market, look, there's a 4 to 6 billion ounce shortfall in London. 4 to 6 billion. That's why they tried so hard to drive the price down here into the end of the year, closing out the stops, letting their balance sheet kind of level off, and they'll take the other side of that. And there's between 700 and 750 million ounces short on COMEX. Most of this is naked, meaning there's nothing behind it, but a big checkbook. And so they've been able to keep the game going for a long, long time, but it ends when the rest of the world continues to buy metals because they don't want our treasuries anymore. So when you asked me earlier about the, what I consider to be financial warfare, the supposed tariffs, they're not, they're sanctions. This is exactly what will continue to make these countries want to continue to use the Achilles heel of the West against us, the short positions on these commodities and the delivery availability. So look, they have enough money to blow it up all at once, but then the game's over. So they're slowly draining the exchanges, not so fast that the whole game ends, but fast enough to see a massive drawdown. You look at the LBMA stockpile of silver, it's a 45-degree angle, and it's falling in on COMEX too. Gold a little bit slower, but it will happen the same way. And I think what will ultimately happen is that the exchanges in the East will take over for the COMEX and the LBMA. They will be rendered a scam. They will be rendered a fractional reserve system. We're not there yet, but I think that there's no question that they understand what we're doing, and they understand the way to win is to use that leverage against us and to do it in a way that doesn't or allows them to continue to do it as long as possible. That's why they're not bitching. They're not bitching because they understand, but they're the ones accumulating, and we're foolish enough to let it go at stupid prices.
When we look at the unfolding drama in the financial markets, silver stands out not just as a potential winner, but as a pivotal player in the systemic shift we're witnessing. To understand the bigger picture, let's dive into the dynamics of silver, its role in the economy, and how its trajectory ties into the broader trends of monetary policy, geopolitics, and global economics. Silver has always been gold's energetic younger sibling. It's more volatile, often outperforming gold during bull markets, and has a knack for grabbing headlines. But what makes silver particularly compelling now is the convergence of industrial demand and monetary necessity. Silver is indispensable in a host of industries, from solar panels to electric vehicles to medical devices. According to the Silver Institute, industrial use accounted for more than half of silver's global demand in 2023, a trend that shows no signs of slowing. The green energy revolution alone could catapult silver prices, as its unmatched conductivity and antibacterial properties make it a critical component in renewable energy and health technologies. Consider this: every electric vehicle contains approximately 25 to 50 grams of silver. As countries worldwide accelerate their transition to clean energy, the demand for EVs will skyrocket. Similarly, the global push for solar energy will require an unprecedented amount of silver for photovoltaic cells. If we're talking about a silver bull market, this industrial demand is a massive tailwind. Beyond traditional industries, silver is becoming increasingly important in emerging technologies. Innovations in 5G, advanced robotics, and quantum computing all rely on silver's unique properties. As these technologies evolve, their silver requirements will grow exponentially, creating a supply-demand imbalance that could send prices soaring. While silver shines in the industrial sector, its role as a monetary metal is equally critical. Historically, silver has been a reliable store of value, especially during periods of inflation and economic uncertainty. And let's face it, economic uncertainty is the only certainty we have right now. The purchasing power of fiat currencies, particularly the US dollar, is eroding. Official inflation metrics often understate the problem, but anyone who has paid a grocery bill lately knows the real story. Silver offers an antidote to this erosion. Unlike fiat money, which can be printed at will, silver is finite. Its value is intrinsic, not dictated by government decree. Central banks understand this. While their focus has traditionally been on gold, we're beginning to see subtle but significant shifts in their behavior. For instance, Russia's rumored interest in silver could be a game changer. If central banks begin to diversify their reserves with silver, the market dynamics could shift dramatically, leading to unprecedented volatility and price appreciation. Retail investors are also waking up to silver's potential. With physical silver becoming harder to source, premiums on coins and bars have surged. This grassroots demand reflects a growing awareness of silver's dual role as a hedge against inflation and a critical industrial metal. As more people enter the market, the upward pressure on prices will only intensify. The East is playing a different game than the West. While Western investors treat gold and silver as speculative assets, Eastern nations view them as strategic reserves. This difference in philosophy is reshaping the global financial landscape. China, India, and Russia are among the countries systematically draining Western inventories of precious metals. By standing for delivery on futures contracts, they're pulling physical gold and silver out of the LBMA and COMEX. This isn't just a short-term strategy. It's a long-term plan to undermine the West's financial dominance. Take the London Bullion Market Association, LBMA, as an example. Silver stockpiles there have been falling at an alarming rate, mirroring trends at the COMEX. This isn't random, it's calculated. Eastern nations are using the West's paper-based suppression of precious metals prices to their advantage, accumulating physical assets at bargain prices. The West's reliance on a paper-based system for precious metals pricing is its Achilles heel. Futures markets like COMEX and LBMA operate on a fractional reserve model, where far more contracts are traded than physical metal exists. This works as long as few investors demand delivery. But as Eastern nations continue to stand for delivery, the system becomes increasingly strained. A tipping point is inevitable. Let's not mince words. We're in the midst of financial warfare. Sanctions, tariffs, and currency manipulation are tools in this battle, but the real action is happening in the metals market. Precious metals are the ultimate form of financial weaponry. They're universal, finite, and immune to the whims of central banks. As the West's financial system creaks under the weight of its own contradictions, Eastern nations are building an alternative. Exchanges like the Shanghai Gold Exchange are gaining prominence, offering a transparent and reliable platform for trading physical gold and silver. Over time, these exchanges could supplant COMEX and LBMA as the global standard, further diminishing the West's influence. This shift has profound geopolitical implications. By accumulating gold and silver, Eastern nations are effectively insulating themselves from Western economic sanctions. This financial autonomy enables them to pursue independent policies, challenging the US-led global order. For investors, this means that precious metals are not just a hedge against inflation, but also against geopolitical instability. So, where does this leave us? For investors, the path forward is clear. Precious metals, particularly silver and gold, are the assets to watch. Silver's dual role as an industrial and monetary metal gives it a unique edge. Its price is still suppressed compared to gold, offering a more affordable entry point for investors. As industrial demand accelerates and monetary demand picks up, silver has the potential to outpace gold in terms of percentage gains. Gold, meanwhile, remains the ultimate safe haven. Its role as a store of value and a hedge against inflation makes it indispensable in any portfolio. With central banks continuing to accumulate gold at record rates, the metal's long-term outlook is as strong as ever. For those looking to hedge against the uncertainties of modern finance, a diversified approach is key. Allocating to both gold and silver allows investors to capture the unique strengths of each metal. While gold offers stability, silver provides the potential for explosive growth, particularly in a bull market. For retail investors, the current landscape represents a once-in-a-lifetime opportunity. The disconnect between the physical and paper markets won't last forever. As the East continues to accumulate and the West's inventories dwindle, prices will eventually align with reality. When that happens, the upside for precious metals could be astronomical. Investing in precious metals isn't just about chasing returns, it's about preserving wealth. In a world where fiat currencies are losing value and financial systems are under strain, gold and silver offer stability and security. Whether you're a seasoned investor or a newcomer, now is the time to act. We're standing at a crossroads. The global financial system is undergoing a profound transformation, and precious metals are at the heart of it. For those who understand the dynamics at play, the rewards could be life-changing. Silver and gold aren't just investments, they're lifeboats in a stormy sea. So as the West continues its slow march toward financial entropy and the East quietly accumulates, remember this: the time to secure your position in precious metals is now. Don't let this historic opportunity pass you by. The next chapter of the gold and silver story is just beginning, and it's one you won't want to miss.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.